Hi everyone. Okay, let's go over exercise 2-3, and if we have time, I'll do exercise 2-4 in the same video. If not, I'll create separate videos. So for exercise 2-3, it wants us to analyze the transactions and then create the journal entries. Okay, and it's giving us an example here. It's done A for us. So on September 1st, Reese invested 15,000 cash in her new business. Okay, so we put the date. We need to put the account titles and the explanations, and it may be good for you to also start creating account numbers based on the rules that you learned for the chart of accounts, but it isn't a requirement for this question. Okay, so Reese invested 15,000 cash in her new business. So we know cash has been increased in the business by 15,000, and the amount of capital that Reese has in the business is also increased by 15,000, which makes it a credit because the capital account's normal direction is a credit. Okay, so for number B, on September 12th, they purchased $2,000 worth of equipment, cameras, on credit. So they haven't paid cash and they've purchased. Okay, so let's go have a look at the solution. Okay, so we talked about the first one. So the second one, equipment. We know equipment is an asset, so it's going to increase by $2,000, so it's going to be a debit. And it's on credit. So they haven't paid cash for it yet, so it's accounts payable. They didn't say that the time was extended, so it's not a loan. So they have to pay it within 30 days, so it's an accounts payable. And then the description would be purchase equipment on, or you could put purchase camera equipment. You could even call it camera equipment if you'd like, but purchase equipment on credit. Okay, so let's go look at the next one. So the next one, purchase $500 worth of equipment, so lighting equipment, paying cash. So we'll come back over here. So equipment, so we've got the date, we've got that it's number C or letter C, and it's equipment for 500, and then we're going to credit cash because we're reducing the amount of cash we have because we're giving them $500 in cash. Okay, so let's have a look. Okay, so the next one. On September 18th, photographed an engagement session for 1,000, collected cash. Okay, so photographed. Well, we should have done this at the beginning, but we'll do it now. So Christina Reese is a photographer who owns Lola Lemon Photography. It's her first month of operation, and the following are the transactions. So photography, so she's photographed, so that's how they earn revenue. So it's going to be a revenue entry, and they collected cash. So let's go over here. So again, D, September 18th, we know the cash has been increased, so we're going to debit $1,000 cash, and we know that photography is how they earn their revenue. They've simply called it revenue here. You could call it photography revenue if you want. Different, out in industry, different companies are going to call it different things. So unless you're given the actual title in your exercise, you could name it slightly different. So anyway, revenue is going to be credited 1,000 because the normal direction or the way to increase revenue is to credit it because it increases your equity. And then the description, provided service for cash. Or you could be more descriptive if you wanted and say photographed an engagement session for cash. Okay, let's look at the next one. On September 21st, photographed a family session for 700 on credit. So again, it's revenue because they did a photography session, and it's on credit. So our customer owes us money. They haven't paid us yet. So that would be what? Accounts receivable. So here we have E, September 21st, accounts receivable, which is an asset, $700. And it's an asset because the customer owes us money. And again, it's revenue again because the reason they owe us money is because we provided the service. So revenue is $700. Okay, so on September 26th, we paid 1,000 regarding B. So look at B, purchased equipment on credit. Okay, so if we've paid them 1,000, we don't owe them 2,000 anymore. So we need to reduce the accounts payable. So let's go have a look. So accounts payable is going to be reduced by 1,000. So we're going to debit it because we're giving them cash for 1,000. So cash is going to be credited. And then we're paying for the equipment or paying the supplier what we owe. The next one, on September 29th, we collected $300 regarding E. So E, we did the family session and created the accounts receivable. Now the family's paying us $300 towards what they owe us. Typically, people would pay the whole invoice, but for the exercise, that's what they're telling us is happening. So let's go down here. Accounts receivable, we're reducing that asset by 300 because our customer paid us 300. So cash is debited, accounts receivable is credited, and we're going to say collection of cash from customer. Okay, so that's the end of exercise 2-3. Let me know if you have any questions about that, and you can always rewatch the video if you're not sure. So let's look at number 2-4. Okay, so for 2-4, using the information from exercise 2-3, they want us to complete the following. Post the journal entries to the general ledger using T accounts. So again, the general ledger and T accounts are the same thing. T accounts are just a lot smaller. They don't have as much information. But make sure that you put the letter from each transaction next to the amount that you post so that if ever asked, you know where the information is coming from, and I can also tell where your information is coming from. So for every post that you put into a general ledger or a T account, you either need to number or letter your transactions or use a date. Okay. And then once we post those journal entries into the general ledger using the T accounts, then we need to balance each of the T account. All right, so let's go have a look. So we need to go back up here. Our first entry for A is cash and capital. So we need A. You can see here under cash, A, and here is the capital. Make sure you put it on the correct side. So for example, we know cash is debited, capital is credited, cash is debited, capital is credited. Okay, that does make a difference. Then for B, we've got equipment and accounts payable. So B, we have equipment, B, equipment, and B, accounts payable. So all you're doing is taking the information from the entries and putting it into the T accounts. So for C, we've got equipment and cash of 500. So we've got equipment, it being increased with C, and cash is being reduced by the 500 from C. D, cash and revenue. D, we've got cash being increased by 1,000 and revenue being increased, but on the credit side for revenue. E, we have accounts receivable and revenue. E, accounts receivable is being increased, the 700, and revenue is being increased by the 700 as the credit. We've got F, accounts payable and cash. Accounts payable is being reduced by the 1,000 because we're giving them cash of 1,000. And then G, we've got cash and accounts receivable. G, we're increasing cash by 300 and accounts receivable is being reduced by 300. Okay, so now we've got them all posted. So now what we need to do, oh, and of course the first one, I think I went over that one already. Anyway, we need to come up with our balances. So what you do for the cash account is add up the debits, subtract the credits, and it gives us an ending balance in the debit of 14,800. Again, accounts receivable, normal direction is a debit, so you take your debit minus your credit to give you a balance of 400. Equipment, we've got 2,500. Payable, the normal direction is the credit, so therefore you take the credit minus the debit to give you an ending balance of your credit of 1,000. Capital is your 15, and your revenue, you have two credits added together, gives you a balance of 1,700. Okay, so now that we have our ending balances, let's go back and see what it's asking us. Oh, number 3, prove the accounting equation, assets equals liability plus our equity. So let's have a look. We've got our assets, which are 14,800 plus 400 plus 2,500 gives us total assets of 17,700. And then we have liability of 1,000. And we have our equity of, if you add your revenue with your capital account, that would give us 16,700, and those added together is your 17,700. So you've just proved the accounting equation. Let me know if you have any questions. Thanks, everyone.